So a liquidity sweep is a sweep of a previous high or low in order to generate liquidity for price to move in that direction. So here you can see the example where we tap into demand, pull back creating this high, demand then fails, and then we sweep this high before coming down, and then we come back, mitigate the sweep before moving off. What could also happen is demand could not fail, so we come down, tap into demand, push up creating this high. Demand then doesn't fail, and then we come back sweeping this high before moving down and then mitigate this sweep. Here you can see the same with supply. We tap in, pull back, supply fails. There's no sweep in this leg, so price comes back, sweeping this low, moving off, mitigating the sweep. And then same thing, tap in, no supply fail before the sweep here, supply fail, and then mitigation. So looking at some examples in the live market. So what you can see here is we create this high, come down, tap into this demand before pushing up, and we create this high here. Try to push down before coming up, sweeping this high, and then pushing down. And then we come into this demand, and you can see the first tap into this demand is here. And then the high that this tap in came from gets swept before price pushes down. And then here you can see we tap into this demand range, and then this high is created from this tap in, which then gets swept into the extreme here before pushing down. So this is our flip model here. We tap in, pull back, flip, but there's no sweep in this leg before demand fails, so we come back and sweep. Here you can see we have this high created, we get a sweep of that high, price comes back and mitigates the sweep before moving down into this demand here. So there was an initial tap in here, which then gets swept, and this liquidates all of the early buyers here before moving off. And then we actually get another sweep here. So we've got a double sweep, which is a bit like a Wyckoff sort of schematic. It's an accumulation, so we get a sweep, another sweep. We don't really trade Wyckoff, but it's that sort of thing, multiple sweeps. Here you can see we have a sweep of this high, push down, come back and liquidate or mitigate. And here you can see we get this demand created, push up, tap into demand, and then we get this high created, come back, sweep this high, and then price comes down, liquidate and mitigates this sweep here. Here, tap into supply, pull back, creating this low. This low then gets swept before moving off. Okay, so we have this supply which gets tapped in here. Price then comes down, and we get a sweep of, so we tap into this wick here, and then we get a sweep of that reaction, to which price comes back and mitigates the supply. Okay, after mitigating this supply, price comes down into this demand here. So the first tap in is here, which then creates this high here, and we've got equal highs. So we then come back, sweeping this high into the extreme. So we've now got this sweep, which we can then trade off of. So as you can see, we've got this supply chain formed here, and this is the perfect scenario because you've got sweep, sweep. So obviously we're trading short. Price then takes this out, and yeah, if you've got any questions on this, leave them in the Discord below, and send for any examples you want to see of sweeps, any feedback you need, because it can be difficult to master this at the start, but if you know what you're looking for, then it's fairly simple. So see you in the next video.